All down. All silent. Going. Go. So congratulations.
Welcome to the Current Market Insights podcast, brought to you by Harris Partners Real Estate. Each episode, we chat with real estate author and industry leader Peter O'Malley to discuss the current property market conditions and provide insights to assist you on your property journey.
Hello and welcome to another edition of Current Market Insights. I'm your host, Kieran O'Brien, and with me as always is Mr. Peter O'Malley. Peter.
Kieran, great to see you again.
Great to see you, buddy. It has been quite a while since we last spoke. There's been a lot going on in the background. You've been talking, obviously, with Louis Christopher, our friend over at SQM Research, about market forecasting, what's been happening across the country more broadly in the last 6 months, and then what the forecast looks like for the next year or so. But given that you've had Louis coming through with his content recently, it's been about a month since you and I spoke. I thought it would be really good today to jump on and talk about what's actually happening in the Sydney market. I'm certainly hearing a lot of anecdotes around, but it would be great to get your thoughts from the inside about how the market's holding up in your opinion, what the trajectory of the market looks like at the moment, and the conversations and the content of what buyers and sellers are saying to you on the ground across your market at the moment.
Yeah, thanks, Kieran. Look, the market is under pressure. I think everybody's picked that up through the media and, just hearing stories anecdotally and following auction clearance rates, etc. So when you piece it all together, I think everybody, acknowledges that the market is off and that downturn has accelerated since the federal budget. It's off on low stock levels. I think that's the most concerning thing, but it's also equally important to temper the negative talk. There are certain sections of the market that are more impacted than others. And unsurprisingly, was it Newton who said for every action there's an equal and opposite reaction?
That's his third law, yep.
Yep, that's his third law. Well, that sort of applies to the Sydney property market at the moment. Those segments of the market that were doing best sort of 9-12 months ago are the segments of the market that are under the most pressure at the moment. So in that comment, I'm referring to Western Sydney. Western Sydney's undergoing a pretty savage price correction at the moment, more so than, say, some of the more affordable sections of the inner city. And we'll talk about what affordable is, relatively speaking, shortly. But then on the flip side, the prestige end of the market, that sort of $5 to $15 million pocket of the market has really slowed down. Sales volumes have essentially halved, if not dropped by more than half. And vendors who want to sell in that segment of the market do need to reduce, and I'm hearing all sorts of reports from 10 to 20% price corrections. So we're talking a $6 million property 12 months ago is now selling for $5 million.
Yeah, it's pretty amazing, especially considering, through some of the slower parts of the market last year, we talked about how that prestige end was really holding up the numbers and keeping volumes, not volumes high necessarily, but keeping values and averages high. So I am a little bit surprised to hear that it's come off, because I think we've always, somewhat speculated that sector of the market is protected a lot from global pressures. The people that have the money to spend in that space typically have the money regardless of what's going on. So to me, that's certainly very interesting.
Yeah, well, apparently they don't have the money.
Yeah. Or, yeah, maybe there's some other reason. The appetite internationally is not the same, whatever it might be. The other thing I guess I want to ask you, you mentioned Western Sydney has taken quite a big hit. The other big thing that's happened in Western Sydney in the last little period is the opening of the 24-hour airport. Now, I don't know about you, but my family and I, we live in Homebush, and it was only 2 weeks ago, I think, or a week ago, I said to my wife, where have all these planes come from? Because I have heard the odd plane going over our place since we moved in 4 years ago, and then all of a sudden, it's just like every half an hour on the clock. It just, you hear something bang, bang, bang.
You're talking about Western Sydney airport planes.
Well, I just assumed that's what it is.
Yeah.
I don't know if it is, but I made that assumption given that it had recently opened and all of a sudden there's so much more plane traffic coming through. Do you think could there be any correlation between, other factors than just interest, inflation, global factors influencing Western Sydney? Or could it be some more localised issues as well that are hampering prices, do you think?
Oh, no, it's everything that you're hearing it to be. It's let me talk about the budget and negative gearing, and I'm not going to go on a wild defence of landlords, but I am going to say some realities about the market and the mortgage market of what has happened to date and how that's been unintentionally or intentionally ensnared in the whole negative gearing changes. We would sell a property as real estate agents, and the buyer would say to us 3 weeks before settlement, can I have a rental letter for the bank? And can you make the rental letter as high as possible?
Yep.
So we'd say, look, the highest we're prepared to say is X. Then we'd send that to the buyer and they'd give it to their broker who would push it onto the bank. And I'm assuming pretty confidently that the broker would say to the bank, my client is going to purchase this property and rent it out and they can get $1,200 a week rent. And then on settlement day, the removal truck pulls up out the front of the house. We drop the keys off to the buyers and they move in. And then you're sitting there scratching your head saying, hang on, I'm pretty certain they've told the bank that they're renting it out for $1,200 a week and they're going to stay living at mum and dad's or in their one-bedroom unit. So that effectively was a lie alone.
Yep.
And I'm not saying everyone did this, but this was a big part of how home buyers were maximising their borrowings in the market.
Yep.
Now when you come to negative gearing being removed, the banks have a whole new algorithm that they've had to rewrite about the investor, the true investor, not getting the tax break. Therefore, what are we really now prepared to pay the lend the investor on the forecast cash flow of this investment property? And that's obviously greatly reduced, which is stopped that money, that credit flow into the market. But what that rule change has ensnared is the home buyer that was getting an investment loan saying I'm renting it out for $1,200 a week and then moving into the property. They're caught by this because they can't borrow as much as they were able to pre the removal of negative gearing. So that just gives you but one more example of how the changes in the budget have absolutely tightened the credit flow heading into the property market. Another unintended consequence that's coming down through the pipe that people will feel much more in the next 12 months is that sales volumes in the New South Wales property market have effectively halved.
Yeah.
If sales volumes are halved, stamp duty revenue is halved.
Yeah.
If stamp duty revenue has halved, the state government will be forced to find new taxes to impose on the people.
Yeah. Increase land tax or find some other, mechanism to do it. I just go back to your first example there. The investor or let's say the owner-occupier who's got a lie loan and was looking for greater borrowing capacity. Do you think that change has had the unintended or intended consequence of reducing prices? Because I assume if they can't borrow as much to purchase the property, is it bringing prices back, or are those buyers now just going to a lesser property than they would previously have done?
Right up until the point that they banned self-managed super funds from borrowing to buy residential property, the government could claim to say negative gearing. They're incorrect on this point, but they could rightfully say, based on our view of the world, negative gearing gives an unfair advantage to a certain cohort of people. We want to level the playing field. But once they did that with the self-managed super fund, that was a absolute admission that we are looking for all credit inflows into the property market and cutting them off where it's reasonable to cut them off to stop pushing property prices up and give the next generation a go. So when Jim Chalmers and Anthony Albanese say we want to make property more affordable, that is politician speak for pushing prices down.
Yeah.
And they have looked, as I say, at all credit flows and said, how do we stop this from happening so that prices naturally fall? Now, my view is that I accept that property prices are too high and it was unhealthy for society and the economy. But you come up with policy that flattens out house prices over 10 years, not 10 weeks.
Yeah.
And that is why I believe the government are going to cop it in the neck when they've got to front the people next, because this was a reckless implementation. The intention was understandable. Everyone can debate the merits of it or otherwise, but I understand the intention of it was reasonable, but the execution of this and the unintended consequences that the economy's about to eat unpalatably over the next 12 months will become extremely apparent and will play badly for the government.
Well, I mean, alongside that, it always, to me, I think the intention is solid, and I think their goal really is to make housing more affordable for the next generation, which is a excellent endeavour. But as you say, for every rich fat cat, to use the common vernacular out there, every fat cat that's raked in millions of dollars in property, there are families that stretched at the height of the market to get a house for themselves, their kids, whatever it might be. And, if they're losing 20 or 30% off their property because of these corrections, some of these people are going to end up, effectively bankrupt without a house to live in.
Well, negative equity.
With negative equity, which is the same thing. I mean, if all of a sudden something changes and the bank says, well, hang on a second, we've lent you $3 million for this house and it's now worth $2 million, they're in a world of hurt. And I think it's pretty unfair, as you say, to do it so quickly where it is going to have such a massive impact on people that aren't, we're not talking about landlords with 2,000 properties just hoarding. We're talking about people trying to get a house in a city that's expensive, near where they work or the kids go to school. It's not unreasonable. It is too high collectively, but I think it's a very dangerous scenario, and I think you're right. The government is going to face an interesting test come election time. Just stepping back, you mentioned right at the start that the market was down. It was quite soft in a period of low stock. Given that we are in the winter period and we're used to low stock in general, can you just, for our listeners' sake, is the stock levels at the moment, are they low for winter in general, or is this a particularly bad year for stock levels, coupled with the fact that we've also got
no parallels with last year.
Okay.
Sales volumes are low in comparison to last year across the board, but stock levels are about their winter norm. It's just a seasonal low, and there's a lot of stock ready to come on the market in spring.
Yeah, okay.
Into a market where clearance rates are anemic. They've been stuck between 30 and 40% since the war started effectively.
Yeah.
In early March. The first weekend after the war started, I think the second weekend after the war started, which was the 14th of March, the clearance rates hit the 30s and haven't come back since. And not the weekend just gone, but the one before that. For the first time in this cycle, the auction clearance rate dipped below 30% and came in at 29.4% in Sydney on SQM Research's numbers.
Which is crazy. If I'm correct, we might have had, since we really started hammering on the less than 50% clearance rate, which was August last year, we might have had 1 week, I think, above 50% in that period. And we're coming up to a year where the auction clearance rate has been dreadfully low. And as you said, below 50% for a sustained period may indicate a downturn, and we're now in a cycle where prices are being pushed down.
Yeah,
it's crazy to me that we are down below 30%. I actually can't imagine anyone out there right now thinking, what I need to do is I need to auction my property this weekend and get a banger price and be on, the front page of the Herald, given these numbers.
There will be, Louis Christopher's numbers are often buried. So a lot of people are going on the mainstream media reporting numbers, which are somewhere between 48 and 52%. So some people will
that's even low for them. I expected higher.
Correct. Yeah, well, they've got to acknowledge what's happening, of course. But some people would still chance their arm on that. But look, let's make no mistake about it. The reason the number of properties go to auction that happens is because real estate agents talk vendors into it against their intuition, particularly in an environment like this. I've got the reverse at the moment. I've got some good listings ready to come to the market, and the owners are reading the press about the auction clearance rate and hesitating whether they should put their property on the market. And what I'm saying to them is that is a reflection on the sale process, first and foremost, not the underlying market conditions, because there's still buyers in this marketplace.
Yeah.
But you need to have a vendor that's aligned with market thinking and understanding based on what we've just discussed that buyers can't borrow as much as they used to be able to from the bank.
Yeah. Yeah. So with that in mind, what kind of conversations are you having at the moment with buyers first You say there's buyers in the market, but what are people saying to you at open inspections at houses that you guys have? Is there any confidence in buyers, or is everyone just kind of cautiously cruising around hoping that something pops up?
Look, we've got a house that we're selling at the moment, and there's 5 offers on it.
Yeah, wow.
We opened some properties for the first time last weekend and got no one through.
Yeah.
So it's really, really important. I think when we did catch up with Louis Christopher, he referred to this market as a meaningful correction, and this is a correction of note. And in percentage terms, some markets are down out to 15% already. Most markets are off by 5%. So what we're seeing as real estate agents is a vendor, if you can't accept that, or you don't like that, or you don't want to partake in that, no offence, just don't put your property on the market.
Yeah.
I'm running into people daily that have spent $10,000, $11,000 on an advertising campaign, another $8,000, $10,000 on styling, and the real estate agents moved them out of their own home or their tenants out of their home, so it's vacant, and they haven't got a buyer.
Yeah.
They haven't got an offer.
They're just hemorrhaging cash.
Yeah, and the reason they're hemorrhaging cash is the agent hasn't sat down and said, these are market realities. I'm not saying you've got to like market realities. I'm not saying you've got to sell under this market reality. But these are market realities, and this is what it means for the price of your property. What do you want to do now? Do you want to go with the market, trade and sell, or do you want to pull back? But real estate agents, stock's low, winter, so desperate for listings. They're out there saying, I can get you sorted, I can get your price. And, some days you'll get the vendor's price in a market like this, but most days you can't.
Yeah.
Not because you're a bad agent, it's the market.
What's, for the vendors out there, what's the major hang up at the moment, do you think, in people kind of not either giving way on price a little bit or being somewhat flexible in terms or conditions or whatever it may be? I mean, typically, as you say, in a falling market, the vendors are typically a bit slower to respond. In a rising market, the buyers are. There's always some give and take. But given that, the media is painting a pretty bleak picture of pricing, which the government is spinning as a positive, there's so much discussion about how the market is falling, etc. What do you think is the major hang-up for vendors as to why they're not meeting buyers in the right spot to get the job done?
Oh, look, I go back to sort of the stages of trauma, stages of grief, and parallel it that way because it's a form of that. And certainly the first thing that a lot of vendors go through is denial.
Yeah.
This is not happening. It's a beat up. I accept that prices in Western Sydney are falling, but here in Balmain or Leichhardt, it's all good. Do you know we've got a tram station now? That sort of thing. That's just denial thinking. The next one, and not every vendor displays this outwardly anyway, is anger.
Yeah.
Well, hang on a sec. You said our house was worth $2 million. Yes, I did say our house was worth $2 million last November, and it was worth $2 million last November. So that's another phase that vendors go through where they're looking to sort of cast blame or lashing out about circumstances. So, I've had vendors in recent times lash out not at me but at Donald Trump for starting the war. Anthony Albanese for his budget, the Reserve Bank for pushing interest rates up when it doesn't really, in their view of the world, contain inflation, for example. So these are some of the things that vendors will find themselves going through as they're coming down to the reality. And then, another phase of working your way towards acceptance on the market is bargaining. The vendor might say, well, if I got to come down, you've got to come down and cut your commission to the real estate agent. Or they might say to the buyer, if they want it for that price, tell them they've got to settle in 21 days. And, no buyer can really settle in 21 days. Or tell the buyers that I can stay here rent-free for, 6 weeks after settlement. They'll invent something. So basically what the vendor's doing is they want to win from the purchaser to make them feel better about the deal. And as you're moving through, as the vendor's moving through those stages, you can feel them moving closer and closer towards, the final thing, which is acceptance of the market and acceptance that the buyer in front of them is the best buyer.
I guess the main challenge with that scenario, though, is that as the market keeps moving, they can effectively restart the cycle, right? Like they may be getting closer to acceptance and then there's a bit more of a correction. So all of a sudden they're back in denial and having to work back through the process.
Look, I don't think we've sat down for 6 weeks. It feels that way, you and I, yeah?
Yeah.
We've seen some shocking examples where we've taken listings over from other agents, and every time the market would take a 3 or 4% leg down, they tweak the owner's price by 1%. And we've sold
always
property,
chasing. Yeah.
or just chasing the market down. And we've seen some really unfortunate examples recently where people have sold for $100,000, if not $200,000 less than they could have, except earlier in the piece the real estate agent didn't have the courage to have a confronting conversation. And hey, whether you think it's the RBA's fault, Donald Trump's fault, or Anthony Albanese's fault as to what's going on, or it's a combination of all of that, the one person who's not to blame for what's going on at the moment is the real estate agent.
Yeah.
But it is the agent's responsibility to be able to articulate what is happening in your market category as a vendor and guide you home.
Yeah. Yeah.
Home being across the line for a sale.
Or out of your home to your next home. That's right. I guess my final question on the vendor space then, is there any correlation, do you find, between vendors who have owned their property for longer being more willing and able to accept the conditions and to move on? Or is it not linked? Like in my mind, I feel like someone who's had it for a bit longer, probably earned a bit more equity, probably feels slightly more comfortable parting with their property, knowing that the market is the market, whereas someone who's bought 2 years ago is a lot more fixed on the price they paid because it's obviously so fresh. I feel like they're going to be a little bit more, not belligerent, but a little more difficult to nudge towards the true price. Do you find that is there any correlation there, or is it truly just a person by person kind of scenario?
It comes back to motivation ultimately. What's the driver? So discretionary sellers that come to us at the moment, we're just saying don't put it on the market.
Yeah,
it ain't going to happen. And then if they keep pushing through that, maybe they're not a discretionary seller. Maybe they're a motivated seller who's trying to wrap it up in we don't really need to sell. We just want to see if we can get our price, so to speak.
Yep.
But to answer your question, it's a fair question that you ask, and a lot of people that wonder what the mechanics of the real estate industry are really like in a downturn will think that someone who's sitting on a gain might act differently to someone that's fighting for every last dollar because they're going out the back door. But unless you've had a dramatic change in circumstances, if you've purchased a property 12 months ago and you're back on the market now, and unfortunately something's driven you to that point. You don't actually have a choice.
Yeah.
So, there's I think the most high profile, I'm not speaking out of school, is a house down in Balmain East. I think it was $19,250,000 that it sold for during the COVID boom. That's a bankruptcy sale now in the media. It's, again, not talking out of school, with an auction guide of $16 million on it.
Ish.
Yeah.
Yeah.
So, and I'm not saying that everyone who bought 12 months ago and is selling now is a bankruptcy sale. But there was another example, I think it was over in Leichhardt, someone showed me the other day, and they took a significant hit on what they paid.
Yeah.
So, if you're doing that, something's forcing you, whether it's a business failure, a job loss. Maybe you are doing it because you've found a much better opportunity elsewhere and you just need the money out. And I hope that's the case for all of those people, but it's probably not the reality of where we're at the moment.
Yeah, no, that's fair. Look, as we move forward then, we talked a bit about the global pressures that are influencing the market at the moment. We've talked about, obviously, the war, which is ongoing. The government making all of its decisions from a policy perspective. We've got so many different influences. But we've also today got some commentary from the RBA around what's happening in the market, what they think is coming. No rate announcements today, thankfully, for everyone with a mortgage. But if you can, take our listeners through what Michelle Bullock and the RBA had to say today, what their concerns or otherwise might be, and where they think the market is headed from here, the money markets, and obviously then the interest rates.
Yeah, so the Daily Telegraph phrased it this way: Reserve Bank boss Michelle Bullock has delivered a stark warning that more interest rate pain could soon be on the way for Aussie homeowners, just one day before a crucial inflation data hits. So we're recording this on the Tuesday. Most people are going to listen to this after the quarterly inflation data comes out tomorrow on the Wednesday, what will it be tomorrow? 29th of July. Yep. And there's a sense that if that number pops, that will drive a rate hike in August. And I think the money markets, last I checked, were 40% on the next move being an increase to the interest rates. Further to what Michelle Bullock said, the further inflation moves from its target and the more embedded it becomes, the harder it is to reverse. Credibility is hard won and easily lost, Miss Bullock said on Tuesday, being today in a speech at the Annika Foundation fundraising lunch. So she's really setting Australians up for further rate pain, there's no doubt. It could be argued that she's jawboning.
That's our favourite phrase when it comes to the RBA. Bit of jawboning.
Well, they're pretty good at it, and jawboning's is everyone's preference to having to make a move with the monetary policy there. So let's hope that is all that's happening. But I think the proof will be in the number, and if that is stubbornly stuck at or above the same levels that it was, you'll probably see the money markets move to pricing in a rate hike in August, which is going to be really damaging.
Yeah, I think they're all damaging at this point.
Another rate hike, if I can say, would take it above the highs of the previous cycle and give us the highest interest rates in Australia that we've had for 15 or 16 years.
Yeah, which, as we've talked about all throughout this rate cycle, the last 2 years or so, it's not a great picture for some people. And there would be many families out there at the moment just hanging on, week to week, getting through it with the current setting. In their statement, did they talk about what the inflationary numbers are at the moment and what they project they may be in tomorrow's meeting? Obviously, we can't fully predict, but any sense of where we may come through and if that will, I guess, indicate how much of a rate rise we may be looking at?
Well, look, it's already above their target band of 2 to 3%. Yeah. Was it 3.6?
I think 3.5 or 3.6 was the last one. Yeah.
So I think that's what caused them to put rates up, and they've had a pause. Yeah. If these quarterly numbers, and we've always said that they have a history of acting on the quarterly number, good or bad, higher or lower rates, more so than the monthly number. So if these quarterly numbers are stuck at the same levels as they were when they increased last time, meaning the interest rate hike did not push it down, that will be feedback, in my view, to the RBA. They have not hit the terminal rate. And the terminal rate is the level at which the interest rate setting of the day pushes inflation down.
Yeah.
So that's what they're looking for evidence for now, is the current interest rate setting pushing the inflation rate down because we're above the target band. And if you read this article that has come out with some people who know far more about this than you and I, they are saying that it is above the RBA's target band. It is not heading back to the target band. They have not hit the terminal rate. This is all the setup, if it's a strong inflation number, for a rate hike in August. Let's hope that's not the case.
I suspect it might be, though. One of the big criticisms of the RBA throughout all of this is that they weren't aggressive fast enough. And they didn't go hard enough. They didn't go fast enough. Do you think, one of the numbers floated in the article is that headline inflation could come in annualised at 4%, which is obviously well above their target range. Do you think there is any chance that Michelle Bullock and the RBA might say, bugger it, inflation is high, let's go hard and really try and knock it back down? Or are they mindful that we are on a bit of a precipice?
0.5%?
Maybe more?
No,
I know.
No.
Like, to me, it would make sense to just go hard now, deal with some pain in the short term, and then let it come back down.
You've got to go back. I understand what you're saying, but you've got to go back to that point we just discussed about Anthony Albanese trying to drive house prices down over 10 weeks rather than 10 years.
Yeah.
Back to a more affordable level. The unintended consequences and that just wipes people out. So by going up by 0.25%, if they felt 0.5% was needed, they should have done 0.25 at the last meeting and 0.25 at this one.
Yeah.
I think they're just edging it up until they hit the terminal rate, and then they'll leave it there until it drops back down. But if the Middle East tees off again, it's not going to
until
drop
the next
back down.
problem comes in and pushes the terminal rate back up, right? Because we did hit it previously.
Yeah, we got just within it, the high end of it, yeah. And that's when they were cutting, when they were in the high end, which was probably premature. But the fuel excise comes off, goes back on, I should say.
Yeah.
On the 1st of August on Saturday.
Yeah.
So I filled up last week at $1.60 and I was like, yes, this is all right, isn't it? And I was like, of course, the fuel excise is off. So that's going to take us back above $2 before too long, which will have an impact as well.
Yeah, look, unfortunately it will. It'll certainly be interesting to see what the RBA do have to say. I'm not optimistic that they will not raise interest rates, though, to be honest. I think it's the numbers are out there. Inflation's clearly there. I mean, I don't know about you, but I feel it in everything. Not just a bit of fuel relief is nice, but supermarket prices of anything is absolutely crazy. So I think it's inevitable.
Oh, look, you just said it would be bad news if we went to 4%, which it would be.
Yeah.
But I saw a report this morning that the Treasury is modelling if the Middle East tees off again, given the price pressures that are already embedded in the economy, it could jump to 7%.
Yeah, which is like I shudder to think.
That's their worst case scenario. I will say it's not predicted, but it's plausible that if it all went off in the Middle East again and the fuel crisis, that the inflation will just jump essentially overnight.
Yeah, which is economic apocalypse. I think I don't know how we would weather that. Most homeowners anyway would be able to weather that in the short term. That's for sure.
Yeah.
The only other thing that we often talk about that comes tied to the RBA in their statements is obviously unemployment. I was reading recently that, with what's happening in the US, their inflation, et cetera, unemployment is getting a little bit crazy over there. Any inclinations, of course, haven't prepped for this, but any indications in your reading that there's, any concern for the labour market at the moment around job numbers and productivity, or is it all holding pretty stable?
Oh, look, no, I haven't read anything on Australia's unemployment that changes my view. I'm only hearing things anecdotal. Corporations and small businesses like ours are doing whatever they can with AI to replace human labour, which is understandable. I think I saw the deputy opposition leader Jane Hume speak last week, and she was speaking about the mindset of small business owners who are working 70 hours a week in their businesses to survive, and they look at segments of the public service that are not making excessive amounts of money, but they're making good wages, working well within themselves, that whole productivity thing. And that's that thing that's happening in society at the moment. The people in the private sector are redlining to survive, and the public sector, as far as the private sector is concerned anyway, is just chugging over calmly and coolly. Yeah. So you've got people at the moment that are sort of don't seem to have a worry in the world, or they're redlining saying, how do I keep these plates spinning? So it is a very interesting time, and the feedback that you get on the employment market really depends on who you're speaking to. And I would suspect that there's a lot of corporations that are ready for another round of significant job cuts if these economic conditions don't unfreeze soon.
Yeah, I wouldn't be surprised. I only ask because I read 2 or 3 days ago, Oracle's just laid off another 21,000, I think, in favour of AI models, etc. So it really is an evolving issue across all sectors. But interestingly, I read an article maybe 2 or 3 months ago now talking about AI transitions at Microsoft. And Microsoft, a very large investor in OpenAI, etc. But someone had done some modelling and showed that, in fact, because of the data cost and the token cost of processing AI for the kind of complex inquiries that are required, it was now costing more per hour to use tokens and AI than it was for the workers in the first place. So all of the efficiency that they were getting, the cost benefit, et cetera, is effectively lost. And I imagine for a lot of smaller businesses who think about maybe transitioning at the cost of labour, it would be a very similar scenario. where a bit of a sunk cost fallacy in a way that they're
I think
not
you
actually
can go
gonna
too
make.
far. That's right.
Yeah.
I've seen that happen with offshoring.
Yeah.
If you remember, everybody offshored everything and then started bringing it back.
Yeah.
And I think personally the answer is a bit of AI, a bit of offshore to keep costs down, but to keep the standards and the IP within the business that the real decisions still need to be made in-house, and those tools like offshoring and AI are just wheels on the side to keep you going, not getting it to do the entire job. Yeah.
Oh, 100%. Look, really great chat today, Peter. I think it's been great to catch up and talk a bit about the market. It has been a little while since we've done so. I imagine when we sit down in a week or two and we go through it all again, who knows where we'll be. I think we're sort of really getting into the thick of winter now. We're in the thick of it. The market is still slow, as you say. The auction clearance rate's been quite grim. I know our listeners are certainly interested, and there'll be plenty of people sitting on the sidelines waiting to gauge the right moment to come to market. But as always, I certainly appreciate your insights, and I know our listeners do too.
Yeah, thanks, Kieran. And we must keep in mind the property market ultimately is just a seesaw.
Yeah.
If it's tough selling, it's great buying.
Yeah. Yeah, it's never in balance. Truly in balance,
If
right?
it's great selling, it's tough buying. So if you know how to play the seesaw, you can get through this period. The key is to keep your job.
Yeah. Yeah, well, that's the hard part, that's for sure.
Yeah.
All right, well, as always, thanks for coming in, Peter. Look forward to speaking with you next time.
Thanks, Kieran.
And thanks to everyone for listening to Current Market Insights. We look forward to speaking with you next time.
Thanks for joining us on the Current Market Insights podcast, brought to you by Harris Partners Real Estate, the podcast providing real estate insights you won't find anywhere else.